This is Brad Berry, Chief Investment Officer and Portfolio Manager with Dynamic Wealth Group. Welcome to this Market and Economic Update. In this video, we'll discuss the financial health of consumers, which is an important indicator of how the economy is doing overall. Some investors may be worried about headlines on rising debt levels and late payments among some consumers, while at the same time, there is some evidence that the overall consumer picture remains healthy. While these facts may seem contradictory, the key is that the U.S. is showing signs of what is sometimes referred to as a two-speed economy. This is a situation where consumers' financial health varies significantly by income and credit quality. Specifically, recent data shows that there is a divide in loan delinquencies by credit quality, with subprime borrowers experiencing sharply higher decline rates, while prime borrowers remain stable or show improvement. Over the next few minutes, we'll show how this is showing up in consumer loans and what it means for the broader economy. Regardless, though, we believe prudent investors and advisors should always plan for a range of outcomes. Your plan should be focused on preparation and not hope or predictions. First, this chart shows the percentage of accounts that are newly delinquent on their payments. This occurs when consumers are late on their payments, beginning with early stage delinquencies of 30 days. This then extends to 60 days, 90 days, and more. As you can see, delinquencies have risen significantly over the past 2 years. Auto loan delinquencies are particularly concerning since consumers typically prioritize these payments due to the importance of having a car for commuting to work and maintaining daily activities. For credit cards, you can see that both 30 and 90-day delinquencies have increased. This suggests that some consumers are facing difficulty paying off their debts and may be facing ongoing financial challenges. Second, it's important to note that many of the delinquencies are concentrated heavily among lower credit score borrowers. As this chart highlights, for auto loans, there are significant differences between subprime and prime borrowers, both in absolute numbers and compared to historical averages. We also see similar patterns in credit card delinquency rates. This is why the two-speed economy means there can be both challenges among some borrowers, even while the overall consumer and economic picture can look healthy. For instance, many banks in their recent earnings calls showed confidence in their consumer portfolios despite these recent trends. Our final chart shows that though household debt has increased since its post-pandemic lows, it is still well below levels seen during the housing bubble and below a historical average. Current debt levels are manageable at around 5.5% of household income. Meanwhile, savings rates have stabilized at 4.6%, creating a generally healthy financial foundation despite being below historical averages. U.S. household net worth also remains near record levels in spite of market volatility, with recent S&P 500 fluctuations only bringing markets back to early September 2024 levels. While pockets of consumer stress certainly exist, particularly among subprime borrowers, overall consumer financial health remains resilient, supporting a cautiously optimistic economic outlook. Now, as I have said many times, I believe preparation wins over prediction over the long run. Hence, being prepared for a range of outcomes is at the heart of our investing philosophy. Now, I hope you found these high-level insights helpful. If you are a financial advisor and would like more information on our multidimensional approach toward asset management, feel free to download our white paper titled Busting 7 Risk and Return Myths. You can click on the link below or visit our website at dynamicwg.com or email us at info@dynamicwg.com. If you are an individual investor, we are happy to address any questions you may have and put you in touch with a qualified advisor if so desired. Until next time, please take care, everyone, and make smart, logical, and fact-based financial decisions.